everyone. Welcome to another episode of Policy and Profits. I'm Anthony Esposito of Yellen Capital. I'm here with EJ Antoni, a research fellow and public finance economist at the Heritage Foundation. EJ, how are you today?
Anthony, I am just struggling to keep up with the news cycle. How are you doing?
I am winning at life today, EJ. I am winning at life. That's how I'm going to put it to myself.
Love it.
News cycle's been crazy this week, as expected. We headed into an FOMC meeting yesterday. There was a 50 basis point cut. I actually wrote my report on the 18th, the day before. And I just want to quote myself for 1 second from my morning report, which you can all get at islandcapitalinvestments.com, on X at CMT_Anthony. The volatility the day before was all expected as we headed into today when a group of dissociated people with a mediocre track record make a decision on something that ultimately makes no difference. So if you want to see that report, islandcapitalinvestments.com. I'll run through that a little later on my model. So 50 basis point cut yesterday from the Fed. I think the odds going into that on the trading desks in the street was about 60% that we would see that. I just want to run through a little bit of the history of what that means and when the Fed has done this. So Powell came out with his explanation, which was non-political, and don't worry, there's no smoke, there's no fire. However, the last time we saw a 50 basis point cut was during the COVID-19 pandemic in 2020. That was 1%. There was a 1% cut in 2008, the Great Recession. There was a 50 bip cut 2002, 2003. Recovery was lagging, and we had low inflation at that point, but we were not quite coming out of that recession. The prior 50 basis point cut was 2001. The dot-com bubble was busting. We had 9/11. And we were heading into recession. And there was a 50 basis point cut, 1990, 1992. That was the Gulf War and recession. So it seems that, in my opinion, this wasn't a 50 basis point cut because everything's great and he wants to stay ahead of the curve. It seems that there's some smoke, and we've talked about the employment numbers, growth, the deficit across the board. We've also talked about how Powell and Yellen are kind of confused with what their role is. I don't know if they think they're social crusaders or if they actually realize that they're in charge of the Treasury and the Fed. But I want to go to a cut, and then I want to ask you just a couple of questions about this. I want to go to a cut of Yellen in an interview yesterday talking about illegal immigration of all things. Forget the deficit and the printing of money, but let's not talk about national debt. Let's talk about immigration. Let's go to that cut.
There was a study, speaking of which, the other day that calculated that undocumented migrants account for 22% of agricultural workers, 15% of construction workers, 8% of manufacturing workers, and 8% of service workers, including childcare workers. In your view, what would be the impact of removing all or most of them from the economy in a short time through a program of mass deportation?
Well, I believe that immigrants have always made and continue to make a positive contribution to the U.S. economy. Between, I think, 2010 we have an aging population withdrawing. It's pushing down labor force participation. Between 2010 and 2018, immigrants made up, I believe, 60% of all additions to the labor force. They obviously contribute to the dynamism of the U.S. economy. And we need, I believe, an orderly immigration system. And there's obviously work to do for Congress to work with the administration to accomplish that. But I think it would be devastating to simply remove
now
this number of immigrants.
So let's just start off here, and then I'm going to toss it to you because I really want to know what you think. First of all, if that's not a Trump commercial, I've never heard one. To talk about the amount of jobs that are actually being given to illegal immigrants versus citizens, I mean, run the tape. Just run the tape. The second thing is that the dynamism in the economy. These are not immigrants. The country's obviously, the nation is built on immigrants and immigration. We're talking about people that broke federal immigration law by crossing the border north or south or east or west and are now here illegally. So we're not talking about immigrants that have come here for a better life to build and to contribute. We're talking about illegal immigrants taking jobs from U.S. citizens. The reason I ran that tape, EJ, is you and I have talked a lot about whether they're political or not, whether they're focused on their mandates or not. So the question I want to pose is 50 basis points. Historically, we can run through. This is normally ahead of or because of economic weakness coming down the pike. Yet Powell has said there's no weakness. This is actually him managing the second part of his mandate, full employment and price stability. What do you think? Was this a political decision? And why do you think he made this call? Was it actually him staying ahead of the curve, trying to decrease the cost of capital and keep the economy, which is strong in his words, still going? Or is there some smoke and fire that he's trying to cover up, 47, 50 days before the election?
Well, look, if they want to, essentially make capital markets deeper and more liquid, if you really want to get that liquidity out to the private sector, then cut out reverse repos, get back to normal reserve levels. But the fact is, the Fed has been using these different mechanisms to create trillions of dollars for the Treasury to spend and then silo all that cash somewhere so it can't get into the private economy. They have been doing everything they can to strangle private markets. And Anthony, I think you hit the nail on the head here. Powell and Yellen are each of them trying to have it both ways, and they simply can't. Look, Yellen, you've been telling us for the last 3.5 years that illegal immigration is not a problem. These people are not taking jobs from Americans. Meanwhile, all the Labor Department data says she's dead wrong. Mm-hmm. But regardless, she's trying to say, on the one hand, look, there's not a lot of them here. They're not taking people's jobs. And now she's trying to say, oh, no, there's so many of them here that if we got rid of them, it would completely devastate the labor market. Again, you can't have it both ways. Now, Powell, to your point, what is Powell doing? He's simultaneously trying to say the economy is so strong that we need to make a maneuver, which we only make when the economy is not very strong. You just can't have it both ways. You can't tell me how strong and robust the labor market is and then say we need to cut 50 basis points to support that labor market. You can't tell me that this has anything to do with measures like GDP, like PCE, the PCE price index, whatever the case may be. Let's not forget, we supposedly have 3% growth now. When we had that during the Trump admin from 17 to 20, what did Powell say? Well, at this rate of growth, we have a risk of increasing inflation, so we need to hike rates. And they did. All the way until the fall of 2019, right before the pandemic. The Fed was hiking rates and they were selling off the balance sheet. It was monetary tightening the entire time. And again, under conditions that were much more benign than what we see today. So we still don't have inflation at the 2% target. There's really no indication that we're actually heading to 2%. We seem to be heading towards somewhere between 2.5% and 3%. I mean, just none of the narrative makes any sense at all.
Yeah. And I like... Actually, we have a chart we're going to toss up as well, and we did last week as well. It's the overlay 1970s to today as far as inflation, the initial spike, the dip, and then the reignition of inflation in the economy. And we're basically, I would say we're rhyming, but we're almost a perfect match on the overlay as far as where we are right now. Inflation early on got just above 12% in the 70s. We got to about 9% recently. We're back down towards 5%. And then obviously we haven't finished. We're pausing there currently, but the 70s, we got back up to 15%. So that chart really shows exactly the risk that Powell, because the tail is now wagging the dog, whether it be the political tail or the market tail, where people are kicking and screaming. And he knew no cut would have been not a massive sell-off, because I love the volatility and it's part of the market. But I would say you could easily bet on a 10% sell-off if he came in at 0. Now, I would also say that the 50 bip cut should have produced and may still produce a 10% sell-off as people digest it as we head into expiry yesterday. We have a triple witch expiry tomorrow. So that is going to put some pressure and some volatility in the market as well. But I think the cut there is leading to a higher inflation risk. Do you agree with that? Do you think that the timing of all of this is actually putting us more at risk versus having, now we have an economy where we're clearly slowing. We're spending, 2 to get growth of 0.5. And now we have a greater risk of inflation heading forward because of this 50 basis point cut, which, by the way, now the market is pricing in another 25 or 50 in the next meeting.
I mean, let's just keep cutting 50 from here on out. It's insane. Again, the underlying fundamentals, which the Fed claims they use, they just don't match up to their actions at this point. They simply don't. And you can tell that just by observing what the Fed has done in the past under similar conditions. And to your point, absolutely, this is going to be inflationary. And the reason we know that, Anthony, is because it's not happening in a vacuum. It's happening with the backdrop of $2 trillion annual deficits at the federal government. We just had the worst August in the history of our country in terms of the deficit. And it's just absolutely insane, as you know, when you look at how much growth is the government actually able to buy with all of this spending? Because look, that's why GDP is up as much as it is. It's being buoyed by massive federal debt loads. When the government goes out and spends money, let's say they do it directly on something like a road, they're going to buy concrete or asphalt to pave it. That gets counted as government spending in GDP. But something that doesn't get counted as government is when they take my money and give it to you and you go out and spend it. That actually gets counted as private consumer spending. And so we're seeing this massive bloat within the GDP figures, whether it's on the public side or on the private side. But in both cases, it's just being driven by government debt. And the scary thing is you are getting less growth than the amount of debt the federal government is having to take on.
Absolutely. So along those lines, we're going to go to the deficit and then come back for a second on the rate cuts. In August, as you mentioned, we spent as a government $690 billion. Of that, $360 billion was new debt, and that got us $300 billion in growth. You just can't function that way. We are spiraling now. It is out of control, and we have Janet Yellen sitting down talking about illegal immigration in a skewed political way rather than handling the Treasury, which is really sad. I wanted to quote Jim Grant. He was actually out today. He had a great quote. I followed him for the past 20 years. He said two things. The soft landing cannot be done. Okay. And then he said something very profound. He said the Fed has a deficit of self-awareness. And I think he nailed it. And he nailed it in his Jim Grant bow tie way. I think they really do have a deficit in self-awareness. They think that they are managing this economy, this market, and they're guiding this plane down to a soft landing when actually, I mean, they're the ones that are going to create the crash. And it's really sad. We have another video to go to, and I really am interested in what you think about this. I'm going to go to the cut now, but we have a then and now was out today from the Bureau of Labor Statistics on mortgage rates, auto loan rates, credit card rates. I want to take a look at this, and then I'd really like to know from you what you think the result of this 50 bip cut here will actually do. What flows through to me when I go to get a car, when I pay my credit card bill, when I go to buy eggs and milk? How is this really going to help in the reality of day to day?
So this is before, like right when the pandemic was striking. I mean, look, you had home loans at 3.5%. I mean, right? Car loans, 5.2%. Credit card interest rates, which are always terrible. Look at where they are today. So the idea of the Fed cutting interest rates would be these numbers would start to come down. You can see mortgage rates have already been falling in anticipation of the Fed cutting rates. They'll likely continue to fall. A lot of really smart people I know say you're going to have a 5 number there sometime maybe early next year or even late this year. So for those people who are looking to buy a home, if you can find one in this tight housing market, or trying to refinance more likely, if you've recently bought, that's going to be the first place you're going to see the effects of lower interest rates.
So how bad did things get? Like, do you have numbers for, because we talked so much about how, I just set it up a second ago, how expensive it is to go to the grocery store. We know gas prices are falling, which is great. So tell us about what we saw in the improvements.
I mean, when you look at the vibe session, people feeling terrible about the economy, this is why. You had housing inflation, 8%. Gas prices at the worst were up 41%.
So EJ, is this really going to help? Well, like, is that more talking heads talking their book, and they really don't have real data to support their opinion on those numbers?
I'm sorry, I'm still laughing that they think home prices only went up 8%. I mean, it's oh my goodness. Behold the elites finally being confronted with the ramifications of their own actions here. This is just going to make things worse. I mean, look, to a certain extent, is this going to provide some relief to consumers eventually? It's going to take a while for those things to trickle down, right? And looking at credit cards, that's a really good case as to why. These are unsecured loans. This is when you don't pay your credit card debt, the bank doesn't just get to collect all the money. They sell that debt usually between 5 and 12 cents on the dollar to a collection agency, and then the collection agency has to try to go after you. So the banks take massive losses on that loan non-performance, and they have to make up for it with very high interest rates on the people who are actually paying. The fact that rates are this high today is not just a function of a Fed funds rate being at 5%. It's also the product of a huge spike in delinquencies because people are increasingly falling behind, and banks are having to reevaluate essentially their actuarial tables and realize, hey, just because you have an 800 credit score anymore is not an indicator that you're necessarily going to be able to pay back your debt, because so many people, again, with good credit are falling on very hard times right now because of essentially the inflation we've had over the last several years and how wages have not kept up. Wage growth has not kept up with all of that inflation. So eventually, are you going to see a small deduction in the interest rate on credit cards? Sure. But is it going to come down appreciably from 30%? No, not really. And if we look at the housing market, you have people with the golden handcuffs sitting on 2 and 3% mortgages that they either took out or refinanced in 2020 and into 2021. I mean, unless you're talking about a couple hundred basis points in cuts, not just 50, you're not going to be able to get people out of those homes and out of those mortgages, and you're really not going to be able to thaw out, I think, this frozen housing market. But then looking at things. Where, I guess, Anthony, where are we going to see the most immediate impact? I mean, theoretically, you should see it in equities markets. You should see it in traditional inflation hedges like gold. I'm curious as to your thoughts here, if that's where you're seeing it right now, and if that's where you anticipate seeing the effects of this big cut going forward. And also keeping in mind that, look, investors are not just pricing things in for today. As you know, they're pricing in future. So we're not just now pricing in this 50 basis point cut that already happened. We're looking ahead and saying, all right, do we have a series of 50 basis point hikes coming down the pike here? And again, how does that impact the investor outlook?
Yeah. So the first thing I'll talk about, honestly, is gold. Gold hit a new all-time high yesterday, up around the 2,600 level. That has been an absolute tear. So gold up about 25% this year with good reason. And it actually hits that high with improving internals and improving momentum. So I don't see a reason for gold. Gold may consolidate here, but I don't see a reason for gold to reverse at any time soon and take a hit. In fact, I was down in Florida probably about 6 months ago now, and we were talking about ultimate price targets. And I still think, and I said at that time, and I still believe that 3,000 is a very legitimate price target for gold. As far as the dollar goes, to kind of shift, the dollar, back in September of 22, and I do use the Dixie, which is the dollar strength versus a basket of foreign currencies. Back in September of 22, we were at 115. Back in early 22, we had broken above par, above 100. We ran to 115. We've now tested par over and over again since that time, since the fall from 115 back in September of 22. We are now really grinding along par, along 100, and I do not think that we're going to hold 100. So I think the dollar will continue to weaken here, which makes sense. That's not rocket science, and I think gold will continue to go higher. The equity markets are very interesting. I definitely had a false signal yesterday. So the model has been and always has been pretty predictive and works well. We had been in a nice positive move. So we had been long the market. We had shifted to neutral last week. Again, I write about this every morning, and I let everyone know where I stand as far as the portfolio positioning and what my signals are saying. The day yesterday and before were very interesting. They both created a very bearish pattern. A shooting star pattern yesterday, for those in the Japanese candlestick world, a very bearish star. We had a big run up coming out of the call, and then we ran all the way back down and closed near the lows. So we created a nice little body at the bottom of the price range with a long tail up to where we hit high. So emotionally, that stick would show that people got excited, Buyers came in, buyers bought up, and then they ran out of gas, and the sellers were like, yeah, I'll make a sale. And I'm going to keep making a sale until this thing closes. So with that, my model actually shifted from positive to neutral. So I saw a lot of reasons yesterday why, along with the fact that there should be some concern for this 50 basis point cut. A lot of reasons why yesterday I believe today would be a lower day. Now, that's not what happened. We actually had a gap up on the open. The overnight futures were ripping. They opened up, I think, 20 on the front month contracts. They were up as much as 103, 108 today. It was just a tear of a rally today. The cash index up 1.7% on the day. So the market, to your point, 50 basis point cut, everyone's been waiting for it. Candy jar is now open again, and everybody jumped in. I do know and I do believe that over time, when we see a cut like this, within 2% of an all-time high, it's happened, I think, 20 or 21 times. I had a trader friend of mine from an energy fund down in Texas send me this stat. So over the past 20 times, we've had a 50 basis point cut, or the Fed starts a cutting process within 2% of an all-time high, which is where we are. 12 months later, we're up on average 14%. So I can buy into that. I truly can. As a portfolio manager and as a trader, I am concerned with 12 months out, but I'm also concerned with what's the drawdown from now and that 12-month period. So we'll see up 14% on average 12 months out, but do we see a 10, 30, 40% drawdown in the process in the meantime, as we hit recession, as people start to pay attention to the fire? And that's kind of where I stand. So the market, really great day today, really great rally. Definitely a head fake, for anyone that was getting out or getting short yesterday on the Fed, the reaction to the Fed. I think there's room for consolidation here with the market, but to be perfectly honest, I need to see, and I wrote this morning, which I'm pretty direct in my opinion. I don't really dance around too much, as you know. But I think, I need to see the next day or two. Today was a nice day. We had a good rally. We closed we had a very small open close range and a much wider. So we open close range about 10 points and then a wider 50, 60 point range, high to low. That shows we had a lot of volatility, and that shows coming into the open, coming out of the close, some indecision. We didn't really move much on an open close range. So kind of like heading into a doji-ish formation, again, a candlestick formation, which shows everyone was excited at one point. Everyone kind of took some profits at one point, and at the end of the day, everyone kind of went home basically where we opened. But it was a nice gap up, and we'll need to hold today's lows for sure to maintain a bullish posture in the market, or else structure of the price action in the market will change if today's lows are broken. I would like to go back to, and thank you for the toss up in the dish on the markets. That was a great way to go from policy into profits. And I know we're running a little short on time, and we're getting towards the end of today, but I do want to run one thing by you because I just love it. It has to do with deficits. I really want your opinion on this, and I don't want you to laugh too much. So please, I know we kind of mess around a lot, but this is important. Kamala Harris is basically an agenda of good feeling vibes, some Marxist propaganda comments, and a lot of fluff and giveaways. So I saw, as I was looking through the deficit numbers, I saw that Harris had the broadband expansion. She backed the broadband expansion bill. I think you remember that. So $42 billion spent 1,000 plus days later. Can you guess at how many people have access to the internet, businesses and individuals that did not have access to the internet before $42 billion and 1,007 days passed?
Oh my gosh. I'm going to say it's got to be less than probably less than 50,000.
Zero people have gained access to the internet as we spent $42 billion. So with that, I really think that Elon Musk and Donald Trump are onto something. If this is how we're running the government, and this is just one thing that popped up, to find $1 trillion in wasteful spending and corruption, I think I'll take that I'll take the over on that. I'm shocked at how we spend money in this country. I'm shocked at the position that they're putting us in. AOC was out today. Again, I have to get your opinion on this. $30 billion social housing authority to work on housing affordability. Are we still in America? Could you imagine going to the government to ask permission and to get direct payment to buy a home that the government now funded for you just because you wake up and breathe.
Oh my goodness. This is, but you know what? It's scary, but this sounds remarkably like Harris's plan, where she thinks the government is somehow going to step in and build millions of homes, as if that's not going to take resources away from the private sector, so that now private home builders are going to build fewer homes in exchange for the ones that the public sector builds. I mean, it's insane. It goes back to this whole idea that you can somehow centrally plan the economy, as if one or two people in a room, frankly, no matter how smart they are, could possibly make by themselves better decisions than 330 million people can working collectively. It's just absolutely insane. And you made me think, though, with the ridiculous amount we've spent on broadband to bring broadband to no one. We spent $8 billion, or I say we, it was really Secretary of Transportation Pete Buttigieg, who spent $8 billion to build exactly 8 electric vehicle charging stations. So it only cost us a cool billion apiece. Billion here, billion there. Pretty soon you're talking real money.
Yeah, we are talking real money, for sure. That's a great one. I like that one. I'm actually going to write that down when we're done. EJ, thank you so much. Great episode. Really appreciate it. Look, things are crazy. There's a lot of volatility, and it's probably going to get worse heading into the election. So I look forward to the next chat, and have a great night, my friend.
You too, Anthony. See you next time.